Imagine waking up one morning and finding that every dollar you spend can be approved, denied, or timed by design. Not by your bank, not by your credit card company, by the same institution that sets interest rates. That's the fear people attach to 3 letters: CBDC, Central Bank Digital Currency. And here's the twist. In the United States, where a retail CBDC has been effectively iced for now, Elon Musk may be building something that looks like the permissionless, private alternative millions think they want, while still having to play by the strictest rules in finance. If Washington never launches a digital dollar, does Musk quietly get the runway to build his own everything app money? Or do the same laws that froze a digital dollar become the trap that limits him? This matters now because 2 things are happening at once. Congress moved to block a digital dollar pilot, and the Federal Reserve says it won't flip a CBDC switch without explicit political backing. Meanwhile, Musk's X Payments is collecting state money transmitter licenses, a tedious but powerful permission slip that lets X hold your balance, move your funds, pay your friends, and eventually pay your merchants. In other words, the dollars are still the same, but the wallet changes, the rails change, and if the wallet is connected to a social graph, a video platform, and a creator economy, the network effects are not theoretical. They are daily behavior. The question is whether that network, attached to Musk's brand and Starlink's reach, becomes a functional substitute for what a retail CBDC might have done without the government's switch in the loop. Let's start simple. A retail CBDC is a digital version of cash issued to the public by a central bank. It can settle instantly, trace perfectly, and be programmed for things like stimulus disbursement or merchant restrictions. That programmability is why privacy hawks worry and why some policymakers like it in theory. The US has pressed pause on that retail version. The wholesale side, the behind-the-scenes plumbing between banks and central banks, is still in research. Projects with the BIS are testing tokenized deposits and wholesale CBDC for cross-border payments. But that's not a wallet in your hand. It's the pipes under the street, which opens up a gap. If the government isn't building you a new wallet, someone else can. That someone else wants to be X. The bones are there: a creator platform that pays you, a marketplace that can charge you, and a social identity that already knows who your friends are. Add licensed money movement and a balance, and X becomes a wallet with a feed. That formula worked for WeChat in China. It could work here for different reasons. In the US, it won't be a government-run wallet. It will be a private, regulated one, subject to state money transmission rules, federal sanctions laws, anti-money laundering duties, and consumer protection regimes. And because those rules apply to everyone moving dollars, Musk's supposed loophole isn't a hole in the law. It's the space the law leaves for private rails to flourish when the public rail is stuck in committee. So, where's the conflict? Start with privacy. Critics of CBDCs say a government wallet lets the state trace and block spending. Critics of private super apps say a corporate wallet lets a CEO trace and block spending. If a retail CBDC seems too centralized, a private network tied to your posts, locations, and subscriptions might feel just as concentrated, only with different incentives. Musk can promise not to censor transactions. He can design for local privacy. But the moment X Payments handles dollars across state lines, it inherits a thick book of rules: sanction screening, transaction monitoring, fraud controls. If your goal was to escape oversight, you won't find it in licensed fintech. And that's the irony. The law that makes CBDC scary to some is the same law that makes an X wallet safe enough to use at all. The real leverage for Musk isn't avoiding the rules. It's stacking assets the government doesn't have. He has a media fire hose that can market payments to hundreds of millions. He has a satellite network that can put payment access in places where cell service is spotty and bank branches don't exist. He has a manufacturing brand, Tesla, that can embed payments into vehicles for charging, tolls, and autonomy. Imagine a car that pays as it drives, a creator who invoices through a post, a village connected by Starlink that onboards to digital dollars without a bank branch. None of that requires a CBDC. All of it benefits if the US chooses not to launch one. But there is a line no private wallet can cross. The government's wholesale pipes still decide when dollars settle in the banking system. Sanctions law still decides which counterparties you can touch. If X wants to move money globally at scale, it either partners with banks and card networks or becomes a regulated bank-like entity itself. And if it tries to jump to crypto to sidestep that reality, it doesn't shed oversight. It adds it. Stablecoins face reserve and disclosure rules. Exchanges face licensing. Wallets face travel rule obligations. The law didn't forget the internet. It brought the internet to the law. So what about the loophole? It isn't some secret exemption. It's timing. If the US won't issue a retail CBDC, the first wallet to make payments feel like messaging can become the de facto interface for money. If that wallet is X, Musk gets distribution that regulation cannot buy. He doesn't need to beat the Fed. He needs to beat your other apps. He needs to be fast, cheap, and delightful, and just compliant enough to scale. He also has something governments rarely optimize for: product velocity. Look at how payments leaders actually won in the United States. PayPal succeeded not because it changed the law, but because it wrapped old law in a better interface for eBay sellers. Cash App grew by turning peer-to-peer transfers into a social habit and then layered in direct deposit, investing, and a branded card. Apple didn't rewrite banking. It put a wallet next to your lock screen, partnered with a bank, and made paying feel invisible. None of them defeated regulation. They domesticated it. If X follows that playbook, the headline isn't "Musk evades CBDC rules." It's "Musk uses the rules to out-UX everyone else." Timing still matters because the public sector is moving, or just differently. The Fed's instant payments rail, FedNow, is live and expanding. Through banks and credit unions, that is not a CBDC. It's a faster pipe that private wallets can tap through their bank partners. If X onboards you with money transmitter licenses, plugs into sponsor banks that connect to FedNow, and automates funds availability, you get the experience people imagine from a digital dollar. Instant cash flow, always-on settlement, without the central bank ever issuing a retail wallet. In that world, the brand you see is X. The bank is a logo on the back end. The government is plumbing. The story feels private, even when it rides on public rails. The legal ceiling for a super app is built from familiar bricks. To take consumer funds, X must maintain surety bonds and permissible investments under state money transmitter laws. To onboard users, it must perform Know Your Customer checks under the Bank Secrecy Act. To monitor flows, it must file suspicious activity reports and screen against sanctions lists. To handle fraud, it must honor error resolution timelines similar to Regulation E if it offers debit-like access. None of that is exotic. All of that is expensive. The true loophole is economies of scope. The same compliance stack that supports peer-to-peer payments can also support tipping creators, paying advertisers, unlocking premium features, and letting businesses settle sales directly in the app. One stack, many revenue lines. Starlink changes the distribution math. Payments fail where connectivity fails. If you control a global constellation that lowers the cost of getting online, you can activate wallets in places that traditional banks don't prioritize. Picture this. A remote workshop uses Starlink to stream and sell. X handles storefront, audience, and settlement. Funds arrive instantly through a bank partner plugged into FedNow. A Tesla parked outside pays for charge and software add-ons as a node in the same account. The services look separate. The balance is one. There are real constraints, and they aren't theoretical. Sanctions compliance is the anvil under every instant payment dream. If X scales payments, it must block sanctioned jurisdictions and persons, monitor evasion typologies, and respond to law enforcement requests. That means transaction surveillance. Privacy won't be a binary promise. It will be a design negotiation. Expect defaults like local-only visibility of social signals, explicit consent for linking identity to payments, NAS and public commitments not to build purchase-based ad targeting without opt-in. The more X leans on trust and transparency, the more credible it becomes as the not a CBDC wallet. Crypto sits nearby like a magnet, but it's not an escape hatch. Stablecoins can make cross-border value movement fast and cheap. They also trigger custodial rules if X holds them for you, securities questions if they're structured poorly, and travel rule obligations for larger transfers. The more a stablecoin looks like a bank deposit in practice, the more regulators will treat it like a bank deposit in law. If X touches crypto, expect it to start with on and off ramps through licensed partners, tightly geo-fenced, and marketed as a convenience feature, not as the backbone of the system. Antitrust shadows the growth story. A wallet inside a dominant social platform that also owns a satellite network and a car OS will attract scrutiny. The legal risk isn't that X takes your bank's job. It's that X favors its own commerce, its own creators, or its own brands in a way that disadvantages rivals. The safest path is open APIs, clear non-discrimination commitments for merchants, and portability tools that let you export payment history and contacts. Those choices aren't just legal armor, they're growth hacks. Interoperability makes a network indispensable. Now turn to what it means for ordinary people and small businesses. If you're a freelancer, a creator, a small shop, or a driver, the difference between a 3-day settlement and instant settlement is the difference between I can restock and I'm stuck. If X reduces fees and speeds up cash flow, it becomes your default invoice and messaging app in one. If you're a consumer, a wallet embedded in the feed where you already spend time squeezes friction out of paying friends, splitting subscriptions, or backing a creator. The risk is platform dependence. If your audience, storefront, and treasury are all inside one company's rules, you're hypersensitive to policy changes and lockouts. The discipline is diversification. Treat X as a high-velocity channel, not the only channel. For Musk's companies, the synergies write themselves. Tesla can turn superchargers into pay-as-you-park services with automatic reconciliation. Starlink can bundle connectivity with merchant accounts for pop-up shops and remote clinics. X can make creator payouts weekly, then daily, then instant, and offer treasury tools for bigger accounts. None of this requires a CBDC. All of this becomes more urgent if a retail CBDC remains off the table in the US, because the private interface to money will get to scale first and then set the norms. The punchline is simple and a little unsettling. If the government won't put a programmable wallet in your pocket, the market will. The law won't be bypassed, it will be embedded. And the person who wins won't be the one who discovered a secret exemption. It will be the one who made compliance disappear behind a delightful tap. If Elon Musk lands that, his empire doesn't dodge CBDC rules. It benefits from their absence. There's a second layer to the timing. Cross-border payments are still slow, expensive, and opaque for small businesses, even as big institutions test new wholesale rails. That gap is cultural as much as technical. If you sell digital goods to fans in another country, you don't want to learn about correspondent banking or currency corridors. You want a button that says, Pay. If X can hide the foreign exchange, front the payout, and reconcile later through bank partners, it gives you the illusion of a seamless global wallet. That's the consumer version of what central banks are prototyping in the back office. And if the central banks never offer you a public front end, you'll just never know the difference. The cautionary tale is Facebook's Libra. It tried to launch a cross-border stable currency and ran into a wall of skepticism from Washington to Brussels. The lesson wasn't that big tech can't touch money. The lesson was that trying to mint new money triggers geopolitical alarms. A super app that simply moves dollars, with banks on the back end and regulators in the loop, is a different story. It respects the unit of account. It competes on usability, not sovereignty. That's the path of least resistance, and it begs a plain question. Would people rather get a government wallet they distrust, or a private wallet they already use for news, video, and friends, trimmed to look respectful of privacy and loaded with rewards? Most days, convenience wins. There's also the car. Payments in vehicles are usually clunky, but a car is a perfect merchant. It knows where it is, when it charges, when it parks. It can subscribe to features and verify identity with hardware you already trust to keep you alive. If Tesla binds vehicle identity to a user wallet inside X, refueling becomes a background event. Long road trips become auto-pay highways. Insurance discounts tie to safe driving behaviors. The experience feels like autonomy is paying its own bills. That's a story a government wallet can't tell, because the government doesn't make your car, run your social feed, or beam you internet from orbit. None of this removes the need for human guardrails. When money moves this fast, scams accelerate. The platform that wins will build friction in the right places. Delayed payouts for first-time recipients, warnings for payments to brand new accounts, one-tap cancels for obvious errors, human review for high-risk patterns. These choices look like cost centers. They're actually retention engines. People don't stay because you never have fraud. They stay because you resolve it fast and fairly. If X marries instant settlement with instant support, the perceived safety can rival that of a bank branch, especially for younger users who have never set foot in one. There is a real upside for small firms if the private rails get this right. Faster cash cycles reduce the need for short-term borrowing. Lower fees widen margins without raising prices. Checkout embedded in a social post collapses the distance between content and conversion. And if a platform pays creators in hours instead of weeks, the platform becomes a workplace, not just a stage. The risk shifts are just as real. Concentration risk grows when distribution, checkout, and treasury live under one brand. Policy changes, content moderation, or account freezes can suddenly become liquidity events. Smart operators will split flows across at least two processors, keep a separate bank relationship for reserves, and export transaction data regularly so they can switch if needed. The platform that helps you do that, paradoxically, earns more loyalty. The most controversial part will be speech and spend living in the same house. If a post violates policy, should the account's ability to receive payments be restricted? If a merchant is sanctioned, should the newsfeed de-rank its offers? These are not abstract questions. They are daily operations inside a super app. The safer posture is separation of powers inside the product. Moderation decisions for content should not automatically cascade to money unless the law requires it. Money decisions should be documented, appealable, and time-bounded. When users can predict how rules apply, they will tolerate rules they don't love. Unpredictability is what kills trust. For people who worry about the surveillance features baked into a hypothetical CBDC, the private alternative can still be built to honor dignity. Clear dashboards that show exactly what data is stored. Local device logs of transactions that don't leave your phone unless you choose to export them. End-to-end encryption for social messages that are unrelated to payments. Explicit opt-ins for any ad products that use purchase history. Annual transparency reports on law enforcement requests and account restrictions. These aren't marketing lines. They are the hard trade-offs that let a payments network survive its first scandal. there's a final strategic truth hiding in plain sight. In the absence of a government wallet, the default wallet becomes the standard setter. If X gets there first at national scale, it can choose to behave like a public utility without being one. It can publish APIs, invite competitors to plug in, and let people port identity and balances across services. That sounds like giving away advantage. In practice, it bakes X into the spine of the economy. The app becomes too useful to fight and too interoperable to fear. This is the kind of soft power central banks usually wield. If a company does it, the law will eventually write the lines around it. But by then, the habits are formed. So where does that leave Elon Musk and the idea of a loophole? Not in the shadows, threading needles through statutes. In the daylight, inside the law, moving faster than institutions built for deliberation. If the United States avoids a retail CBDC and the private market makes money feel like messaging, the empire doesn't sidestep the rules. It crystallizes around them. The edge is not a secret. It is execution at the speed of culture. The takeaway is this: if a digital dollar never arrives in your pocket, the experience of a digital dollar still will, and the winner will be whoever makes legal compliance invisible and instant. What would you trust more with your paycheck and your privacy? A wallet from Washington or a wallet you already open 20 times a day? There's one more fork in the road that will shape everything you've just heard. If Congress permanently fences off a retail CBDC, it doesn't switch off innovation. It forces innovation into private wrappers. That means the real battleground becomes which private stack earns the right to feel like public infrastructure. If X moves first and proves out instant settlement with bank partners, lower fees for small merchants, and clear privacy defaults, it can normalize a pattern other platforms must copy. If it stumbles on fraud, outages, or a messy content money crossover, another wallet will take the crown. In practice, the winner will be whoever makes your first 10 payments boring and your first fraud resolution painless. That may sound small. It's not. Trust at the edge is policy by other means. Watch the states because they are the front lines of payments law. Money transmitter licenses are state grants. Consumer protection investigations often begin in state attorneys' general offices. Privacy regimes like California's set national de facto standards just because the market is too big to ignore. If X promises a privacy-forward wallet, it will design to the strictest state and call it the baseline. That's how payments products in the US typically mature. One compliance stack, tested against the hardest audience, rolled out everywhere else. The companies that win don't argue with the referee every play. They run the ball inside the lines until the crowd forgets the lines are there. The global angle matters because the audience is global even when the law is not. Europe is moving toward tighter e-money rules and a narrow bank-centric vision of a digital euro. China has already piloted a state wallet. The Gulf is leaning into cross-border experiments. None of those models will be copy-pasted here, but they will inform expectations. A merchant in Lisbon who sells to fans in Los Angeles wants to know why the European bank transfer is free, while the US card fee is not. A gamer in Manila who streams to followers in Texas wonders why a payout takes 2 days. If X solves those frictions in practice, the narrative about CBDCs becomes academic. People will choose the fastest path that honors their dignity and gives them recourse when things go wrong. It's worth pausing on what dignity means in product terms. It means you can see what data is collected about your transactions and why. It means you can freeze your account in one tap and thaw it after you talk to a human who can make decisions, not just read a script. It means you can export your transaction history to your accountant without begging support for a CSV. It means when a law enforcement request arrives, the platform notifies you unless the law forbids it and reports aggregate numbers publicly every year. These are not abstract promises. They are features you can ship. If you run a small business, ask a simple question. What would you do if your daily payout arrived in seconds, not days? Would you restock faster, spend on ads earlier, or hire one more part-time worker? Would you accept smaller tips if they were certain and instant? The multiplier from cash velocity is real even at tiny scales, and it's one reason private rails that feel instantaneous will beat a theoretical public wallet that never shows up. The economy changes when you compress the time between effort and reward. A platform that does that credibly earns the right to offer credit next, then insurance, then wholesale discounts, always with the same compliance spine humming in the background. If you're a consumer, the benefit feels like time. No more waiting for transfers to clear. No more hunting for clunky bank logins to split a bill. No more asking your friend which app they use, because everyone you know already has the same feed and the same balance. The risk is overreach. If the same account that pays your rent also controls what you can post, any enforcement mistake can feel like financial exile. That's why separation of powers inside the product is not just good governance. It's a growth feature. People will trust the wallet that treats money like a utility even when speech gets loud. Now zoom back to Elon Musk. The empire expands not because he finds a loophole in CBDC law, but because the absence of a government wallet creates a market for the first private wallet that feels public. X can win that race if it chooses discipline over spectacle in the places where it matters. Compliance first, privacy by default, instant service when something breaks. Starlink gives it reach. Tesla gives it use cases. The feed gives it habit. If those pieces click, the payments layer becomes invisible, and the headline 3 years from now will not be about CBDC. It will be about how money quietly became another tab on a platform millions already use without thinking. You can already see the early signals. Licenses stack up. Partnerships with banks quietly fill the gaps. Features arrive that look minor until they are everywhere. Tipping without fees for a limited time. Merchant onboarding with same-day approval. Instant refunds for disputed microcharges. At first, it feels like perks. Then it feels like table stakes. That's how new norms are born in consumer finance. Slowly, then suddenly, then forever. The most powerful sentence in this story is deliberately unsensational. Compliance scales distribution. It's not a tweet that goes viral. It's a blueprint that becomes culture. If X codifies that culture in product choices and public commitments, it won't need to fight Washington on CBDCs. It will simply render the question irrelevant for most people, most days. The wallet that is open, predictable, and boring will win. And boring, at scale, is revolutionary. So here is the one-sentence takeaway you can carry into any debate about CBDCs and big tech. If a digital dollar never arrives, the private wallet that makes legal money feel like messaging will set the rules the public eventually writes down. What do you want to see when you open that wallet for the first time? A balance and a send button, or a dashboard that proves it deserves your trust? Picture the rollout. It begins in a handful of states where licenses are cleared and bank partners are ready. The first feature is simple: peer payments inside the app with instant availability for verified users. It feels like sending a DM, then come merchant QR codes and one-click checkout in posts. Small creators notice faster than big brands because cash flow is oxygen. They switch their tip jars first, then their memberships, then their storefront links. A few car owners see over-the-air updates that let the vehicle handle charging bills in the background. A few rural clinics use satellite connectivity to run pop-up checkouts for health fairs and pay volunteers the same day. Each piece is small. Together, they create a new default behavior. Open the app, move money, forget the wait. A government wallet would have showcased policy goals, benefit disbursements, targeted rebates, programmable limits at the edge. A private wallet showcases product goals, speed, delight, rewards. That doesn't mean it floats above the law. It means the law becomes an ingredient, not the dish. The constraint that once looked like a roadblock becomes a competitive moat. If you can pass the hardest audits and still ship a delightful experience, you've turned regulation into something your rivals can't copy overnight. You can sense how this changes the conversation around privacy without promising the impossible. Instead of selling secrecy, the platform sells certainty. It tells you exactly what it logs, why it logs it, and how long it keeps it. It shows you where decisions are automated and where a human can step in. It lets you separate your social identity from your spending identity unless you choose to link them. When a payment is declined for compliance reasons, it gives you a reason code and a path to fix it. These are small acts of respect, but they diffuse the fear that money can be silently shaped by someone else's politics. Respect scales faster than rhetoric. There will be moments that test the thesis. A high-profile account will be frozen for suspected fraud, and the backlash will be loud. A sanctioned entity will try to route funds through a web of cutouts and get caught, and critics will claim the dragnet was too wide. A bug will delay payouts for a day, and merchants will panic. Those are the days when boring process saves a flashy brand. Publish the incident timeline quickly. Make affected users financially whole. Explain which controls worked, which failed, and which are now stronger. When you treat people like participants instead of passengers, they forgive the bumps because they recognize the road. In the background, the wholesale experiments will keep maturing. Banks will settle faster with each other. Cross-border corridors will be tokenized a layer down from anything consumers can see. When that plumbing is ready, the best private wallets will adopt it automatically through their bank partners, and the experience will tick a little closer to the platonic instant. No speech, no announcement, no law changed, just the quiet progress of Rails getting better while the interface stays familiar. That is how infrastructure wins hearts, invisibly. Imagine the end state 3 years out if the bet pays off. You wake, check messages, and a pending payment from a client is already posted. You book a last-minute flight and see an instant merchant refund from a canceled ride. You send a micro-bonus to your project collaborator in another country, and neither of you thinks about exchange rates or settlement windows. You watch a creator break down complex policy and tap twice to unlock their next series, knowing you can reverse it within minutes if you tapped by mistake. In the evening, your car charges at a station you've never used before, and the receipt appears quietly alongside your trip log. None of these moments needed a central bank app. All of them required someone to make compliance vanish into the background of daily life. That is the quiet revolution hiding inside the debate over CBDCs and loopholes. When the public wallet remains theoretical, the private wallet that feels like public infrastructure inherits the future by default. It will win, not because it discovered a gap in the law, but because it embraced the law so thoroughly that ordinary people stopped noticing it. If Elon Musk's stack pulls that off, the phrase CBDC loophole will age into a misnomer. There was no loophole, there was execution. So here is the single sentence that captures everything we've explored. If Washington never puts a programmable dollar in your pocket, the platform that makes legal money move at the speed of culture will define how money feels, and everyone else, including policymakers, will adapt to that feeling. Now ask yourself one last time, as both a citizen and a customer, when the wallet that wins asks for your trust, what proof would you need to say yes today? For small businesses and creators, the immediate move is pragmatic. Open a second lane for revenue that settles fast and proves it with a week of side-by-side testing. Keep your current processor, but route a slice of sales through the new wallet to measure speed, failure rates, refunds, and support response times. If the numbers are better, widen the lane, export your data weekly, and store it somewhere you control so you can swap vendors without starting over. Treat the platform's perks as accelerants, not anchors. If a reward expires, your business should not. Consumers should calibrate trust the way they do with any new financial tool. Start with low limits. Set alerts for every transaction until you stop being surprised. Separate your social identity from your payment identity if the product allows it, and only link them when you see a concrete benefit, like faster dispute resolution or higher limits. Use the built-in privacy dashboards and actually read them once. The exercise is short, and it changes how you use the app. Investors should map the revenue stack like a pyramid instead of a monolith. At the base is payment volume and float. Above that are interchange splits on co-branded cards, instant payout fees, and merchant tools. Above those are creator monetization, subscriptions, and commerce. At the top are credit and insurance adjacencies that require impeccable risk and compliance telemetry. If the company communicates its controls clearly, the upper layers become plausible, not speculative. If it treats controls as window dressing, the pyramid flips and the risk sits under everything you value. Regulators should take yes for an answer when a private wallet volunteers to behave like a common carrier. If a platform publishes APIs, neutral access rules, appeals processes, and auditable privacy controls, the right response is not to swat it down for ambition. The right response is to hold it to its promises, verify performance, and translate successful norms into broader guidance. That approach protects the public interest without freezing the interface that people actually use. There is a deeper civic benefit to getting this right. Money that moves as easily as messages creates space for new forms of work that don't fit into the old fortnightly payroll. Microgigs, pop-up services, and creator economies are often dismissed as hobbyist until the tools catch up. When settlement is instant and predictable, these edges harden into real small businesses with real tax receipts and real forecasts. Policy debates about CBDCs often skip this texture because the conversation happens at the level of institutions. But institutions are just the scaffolding around daily choices. If a product dignifies those choices at scale, the scaffolding adjusts. Skeptics will argue that no private company should sit between a citizen and their paycheck. They're right to be wary. The counterweight is design. Separation of powers inside the product, portability of data, clear reasons for adverse actions, and human paths to resolution are not luxuries. They are the minimum conditions for legitimacy when speech and spend share a roof. The platform that publishes these conditions in public and lives by them will earn the cautious trust that governments sometimes struggle to command in software. This is why the story you just heard is not really about loopholes or personalities. It's about tempo. Public finance moves on deliberation. Consumer technology moves on iteration. When the public chooses not to launch a retail wallet, iteration sets the tone by default. The winner is whoever makes compliance disappear behind a smooth tap and proves repeatedly that the dignity of ordinary users is non-negotiable. That promise is measurable. You can feel it in the first refund, the first friendly audit trail, the first time support fixes a mistake before you finish your coffee. So let's bring it back to a single line you can keep in your head the next time someone says CBDC like a spell. If Washington never issues a retail digital dollar, the app that makes lawful dollars feel instant will become the dollar most people experience, and policy will follow practice. Here is the question I want you to sit with as you close this video. When the moment comes to choose a wallet, what proof of respect would make you move your first paycheck, not just your first tip, into a platform you already open 20 times a day?